Good afternoon. Since the previous meeting of the Monetary Policy Committee, the global economic and political landscape had changed significantly following the US presidential election. The high degree of uncertainty surrounding the economic policies of the new administration is expected to persist for some time, creating a more challenging and volatile environment for emerging markets in particular. Higher US long bond yields, along with expectations of a tighter stance of monetary policy by the US Fed than previously expected, have contributed to the reversal of the recent positive sentiment towards emerging markets. The prospect of rising protectionism and its implications for world trade are also a concern. These developments have also affected capital flows to South Africa, with implications for the rand and bond yields. Domestic growth and inflation dynamics have remained more or less in line with expectations, but risks to the inflation outlook have increased moderately. The year-on-year inflation rate, as measured by the Consumer Price Index, CPI, for all urban areas measured 6.1% and 6.4% in September and October, respectively, compared with 5.9% in August. The October outcome was marginally above the bank's forecast. Food price inflation accelerated further to a recent high of 12%, with the category of food and non-alcoholic beverages contributing 1.8 percentage points to the overall inflation outcome. Goods price inflation measured 7.1% in October, up from 6.6% in September, with non-durable goods inflation rising to 7.6%. Services price inflation increased from 5.6% to 5.8%. The bank's measure of core inflation, which excludes food, fuel, and electricity, measured 5.7%, up from 5.6%. Producer price inflation for final manufactured goods measured 6.6% in September and October, down from 7.2% in August. The main contributor to October outcome was the category of food products, beverages, and tobacco products, which contributed 4 percentage points and reflects the continued impact of drought on food prices. The latest inflation forecast of the bank is broadly unchanged over the forecast period, despite a moderate upward adjustment to the food price forecast in the later quarters. The annual averages are unchanged at 6.4% for 2016 and 5.8% and 5.5% in the coming 2 years. Inflation is expected to peak at 6.6% in the fourth quarter of this year, marginally lower than in the previous forecast, with a sustained return to within the target range still expected to occur during the second quarter of 2017. The higher food price assumption is offset by a slightly more appreciated exchange rate assumption. Core inflation is expected to average 0.1 percentage point less in each year of the forecast period compared with the previous forecast at 5.6% this year and 5.5% and 5.2% in 2017 and 2018. Core inflation is expected to remain within the target range over the forecast period, with a peak of 5.8% in the final quarter of this year. Annual inflation expectations of economic analysts, as reflected in the Reuters Econometer survey conducted in November, are broadly unchanged since September and are similar to those of the bank. The median forecast for the current and next 2 years are 6.3%, 5.8%, and 5.6%. The bond market expectations implicit in the break-even inflation, that is the yield differential between conventional government bonds and inflation-linked bonds, increased in the wake of the recent depreciation of the rand. They remain above the upper end of the inflation target range. The global outlook has become increasingly uncertain during the year following the UK decision to leave the European Union and the outcome of the US presidential election. While the new policy direction in the US is unclear, the markets have interpreted the outcome as being positive for US growth in the short run, with commitments to tax cuts and higher fiscal spending on infrastructure. These policies are expected to result in higher growth and inflation, particularly against the backdrop of an increasingly tight labor market. Nevertheless, the timing and the extent of the expenditure boost is highly uncertain at this stage. While an increase in infrastructure expenditure could be positive for commodity prices, other aspects of the possible new policy direction are likely to have an adverse effect on emerging markets. These include a possible more aggressive tightening of US monetary policy in response to higher inflation and growth, which could also reduce the multiplier effect of fiscal expansion. Together with the recent sharp increase in US long bond yields, the possibility of such actions has led to a reversal of capital flows to emerging markets, reminiscent of the market reaction of the so-called US taper tantrum of 2013. The impact on emerging market currencies and bond markets, including South Africa, are already evident. During the high degree of uncertainty, the financial markets may have overreacted. A further concern for emerging markets is the potential change of trade policies that may impact on existing trade treaties, as well as unilateral increases in tariff protection in the United States. The outlook for emerging markets has therefore become more uncertain. The lingering concerns about the sustainability of the recovery in the Chinese economy have been revived by the possibility of tariff increases on Chinese exports. Countries with strong direct trade links with the US, in particular Mexico, are more vulnerable to increased trade barriers. A more protectionist US stance could reinforce the already slow growth of global trade. The short-term fallout of Brexit on the UK economy has been limited to date, due in part to the accommodative monetary policy response. The longer-term impact remain unclear, as the terms of withdrawal are still to be negotiated, and there are concerns that a delay in clarity could undermine investment. The Eurozone is expected to continue with its slow but steady recovery, and the Japanese economy continues to battle with deflation. Global inflation remains generally benign, and since the previous meeting of the MPC, a number of countries have loosened monetary policy. Expansionary policies are expected to persist in the Eurozone, Japan, and the UK, despite emerging inflation pressures in the latter. By contrast, a persistence of significant outflows from emerging markets in response to the possibility of tighter US monetary policy stance could pose challenges for monetary policies in a number of these economies. These new global developments are impacted on the have impacted on the domestic bond and foreign exchange markets. The rand appreciated steadily from the middle of October in response to some positive domestic developments as well as inflows from a large M&A transaction. The currency was trading at around 13 rands 20 against the US dollar just before the elections. It then reached its weakest point of 14 rands 60 against the US dollar in the wake of the surprise outcome before recovering somewhat. Domestic long bond yields, that is the R186, initially spiked by about 60 basis points, but the increase has since moderated to about 25 basis points. Since the previous meeting of the MPC, the rand has depreciated by about 5.7% against the US dollar and by about 1.1% on a trade-weighted basis. The rand is expected to remain sensitive to changes in the stance of US monetary policy. A US rate increase is generally expected in December and probably largely priced in. But of greater significance for the rand will be the signals from the FOMC regarding the trajectory of future rate increases. The rand will also remain sensitive to the sovereign ratings announcement due later this month and in December. On the positive side, the rand has been given support by generally improved trade account in recent months. However, the deficit on the current account of the balance of payments is expected to have widened in the third quarter of this year. The financing of the deficit may become more challenging should the recent significant non-resident sales of bonds and equities persist. During October and month to date, non-residents have been net sellers of domestic bonds and equities to the value of 42.7 billion rand and 19.7 billion rand respectively. The domestic economic growth outlook remains subdued, although the low point of the cycle appears to be behind us. The bank's forecast remains unchanged at 0.4% for 2016 and 1.2% and 1.6% for the next 2 years. Whilst the estimate for potential GDP growth was revised down marginally to 1.3% and rising to 1.5% by 2018, the output gap is expected to remain negative over the forecast period. The bank's composite leading business cycle indicator improved in August and September, continuing a recent generally positive but gradual upward trend. Available monthly data suggests that growth in the third quarter is likely to be positive, but well below the rate recorded in the second quarter. The mining sector contributed positively to GDP growth in the quarter. The physical volume of manufacturing output declined despite a positive month-to-month outcome in September. The Barclays Purchasing Managers Index, the PMI, which declined further in October, has remained below the neutral 50 index point level for 3 consecutive months. The weak trends in manufacturing are consistent with the continued low levels of business confidence, despite a moderate improvement in the third quarter. More positively, the services sector is expected to sustain its positive growth rate, with the tourism sector being particularly buoyant. Consumption expenditure by household remained subdued, with declining retail trade sales and static wholesale trade sales in the third quarter of this year. Although new motor vehicle sales increased sharply on a month-to-month basis in October, a sizable portion of this is attributed to car rental companies, and challenging conditions in the new vehicle sector persist. consumers continue to face a number of constraints. Employment growth is particularly weak. Household debt levels, while moderating, are still elevated, and wealth effects are muted amid stagnant equity and residential property markets. Furthermore, growth in credit extension to households remains subdued. Slow growth in household disposable incomes is also reflected in a gradual decline in wage growth, with growth in nominal remuneration per worker declining to 5.8% in the second quarter. When an adjustment is made for increases in labor productivity, growth over 4 quarters in nominal unit labor costs measured 5.1% in the second quarter. The Andrew Levy Employment Publications Survey reports an average wage settlement rate in collective bargaining agreements of 7.5% in the first 3 quarters of the year and 7.1% in the third quarter. This may be indicative of wage settlements becoming more sensitive to the persistently high unemployment rates. According to the medium-term budget policy statement, the MTBPS, released in October, fiscal consolidation is set to continue at a measured pace. A moderate degree of slippage is expected in the near term as tax receipts are negatively affected by the economic slowdown. In order to prevent an excessive widening of the fiscal deficits, the MTBPS proposed a reduction in the expenditure ceiling and tax increases to be announced in February. A revised deficit of 3.4% of GDP is expected in the current fiscal year and steadily narrowing to 2.5% of GDP in the 2019-2020 fiscal year. Food price inflation remains a significant driver of inflation and is sensitive to continuing drought. While food price inflation is still expected to moderate from early 2017, the pace of decline is expected to be slower than previously forecast. This has led to an upward revision to the food price assumption in the forecast during the outer quarters in particular. The change is mainly due to the delayed impact of meat prices, which are now expected to peak only in early 2018 as farmers rebuild their herds during 2017. Brent crude oil prices reached a year high of $52 per barrel in early October, following the OPEC agreement to curtail production. Since then, prices have declined following doubts about the prospects of an agreement on the distribution of production cuts across the cartel. Some price volatility is expected in the short run as negotiations on production cuts continue. The bank's forecast maintains the assumption of a moderate upward trajectory of international oil prices over the forecast period. The domestic price of 93-octane petrol increased by a cumulative 88 cents per litre in October and November, with almost all of the increase due to higher international product prices. The current over-recovery indicates that should current trends persist, about half of that increase could be reversed in December. The MPC is of the view that a high degree of uncertainty surrounds the nature and timing of possible policy changes emanating from significant developments in the global economic environment. This elevated uncertainty creates a more challenging environment, especially for emerging markets, as evidenced in the recent changed pattern of capital flows. Financial markets are thus likely to remain volatile for some time. Since the previous meeting of the MPC, the inflation forecast have remained largely unchanged. Whereas the risks to the inflation forecast were previously assessed to be more or less balanced, the committee now assesses the risks to be moderately on the upside. This is mainly due to the possible impact of adverse global developments on the exchange rate. The risk of domestically generated shocks to the exchange rate also remain. Nevertheless, despite its high degree of volatility, the rand has displayed relative resilience in the face of numerous shocks over the past year. The domestic growth outlook is unchanged and remains constrained against the backdrop of weak business and consumer confidence. The risks to the growth forecast are assessed to be broadly balanced. Domestic demand pressures remain weak, and consumers are expected to remain under pressure for some time. The MPC has accordingly decided to keep the repurchase rate unchanged at 7% per annum. The decision was unanimous. The MPC remains concerned about the inflation trajectory, that the inflation trajectory is uncomfortably close to the upper end of the target range. Furthermore, the uncertain environment and moderately higher risks to the inflation outlook require continued vigilance. Whilst the committee retains the view that we may be close to the end of the hiking cycle, there may be a reassessment of this position should the upside risks transpire. Thank you very much for your attention. As usual, let us move to the questions and identify yourself and the media house that you represent, and we shall deal with your questions accordingly. Right here in the front. Miriam. A microphone, please.
Hi. Okay. Yeah. It's Mariam Issa with Finweek. I have two questions.
With Finweek?
Yeah. I have two questions. One is, if the US raises interest rates more aggressively, could this have repercussions for us in terms of leading to more rate hikes in the future? And my second question is, you spoke of the possibility of negative fallout from rating downgrades. Have you got any projections on what this fallout could be? There's talk that the bond impact could already be priced in, but markets tend to get ahead of themselves, and if they start speculating on further downgrades, is there a risk that bond yields could rise further?
Thank you. Any other question? Yes, ma'am.
I'm Khelang Bata from Bloomberg News. I'm not sure if this question was asked already, but was a rate cut discussed at all?
One more in this round. Hillary?
Hilary Jaffe from Business Day. Governor, what is the committee's assessment of whether a possible downgrade by one or more of the rating agencies has already been priced in by the markets? And has the bank looked at what the impact would be of a local currency downgrade by the one rating agency, even if not a foreign currency downgrade? Thanks.
Okay. US rates being raised aggressively, what would be the repercussions for South Africa? As we had previously said, we do not follow pound for pound or basis point for basis point what the US does with its policy rates. We started our tightening cycle much earlier to deal with the inflation challenges that South Africa was facing. This time is no different. We will assess what a US rate hike means for South Africa. And as usual, we have got to be guided by whether that rate hike is fully priced into the current financial markets or is not fully priced. If it is fully priced, then you would expect that the markets will say it's a no-brainer. But to the extent that it is not fully priced, there will be a reaction should there be a rise in rates. And for us, we had identified that if the U.S. raises rates because they believe that the U.S. economy has recovered, is strong, is creating jobs, and that prices in the U.S. are beginning to rise, that is good for the global economy. And if it's good for the global economy, surely South Africa should benefit from a global economy that is performing well. We also expect that should the U.S. raise rates, there will be a repricing of within the financial markets to the extent that that pricing is not fully factored into financial markets. But we have also seen in the run-up to the FOMC meeting and the developments in the U.S. of a dollar that is strengthening against other currencies. So you are seeing a global realignment of exchange rates, and the rand would also realign within that context. And of course, in that realignment, if the rand ends up being weaker, we are faced with two situations. We could treat that as a once-off shock, if it is a once-off shock. And if it does lead to a situation where generally prices in South Africa begin to rise as a result of a depreciation of the currency, in other words, leading to second-round effects, then policy is then going to have to respond to deal with the second-round effects. So put simply, policy will not be responding because the U.S. has raised rates. Policy will be responding to the consequences of the rise in U.S. rates. Was the possible fallout from you said a ratings downgrade? I say a possible ratings downgrade, because at the moment it just remains a possibility. The situation in South Africa, the fundamentals in South Africa are different from the last time the rating agencies had put us on terms, which is why when they did the previous review, they decided to keep our rating the same. Be that as it may, putting your case to the rating agencies is one matter. The other is that the rating agencies' decisions are taken by ratings committees. So we shall await what the rating committees decide, and to the extent that the possibility of a downgrade is factored in current financial market prices, then a downgrade will be a no-brainer. But to the extent that it is not priced in and it takes place, you will expect a repricing in financial markets. On the other hand, if the financial markets have priced in a downgrade and the downgrade does not take place, we would expect that there would be a positive repricing in financial markets as well. To what extent do we, Hillary, to what extent have we worked this thing into the pricing? Difficult call to make, because there are players who would take a view that there is going to be a downgrade, and there are players who will take that there will not be a downgrade. That is the beauty of an efficiently functioning market, because views get to contest, and those who got these things wrong, they pay the price for getting them wrong, and those who get them right get rewarded for getting the pricing right. Local currency downgrades, you are aware that the local currency rating is higher than the foreign currency denominated rating. And for the purposes of the domestic bond market, what matters is the domestic currency rating, because that's what feed into the world bond indices that take account of which bonds to include in those respective indices. Even if there was to be a downgrade on the local currency denominated ratings, we do not expect that that would drop below investment grade, because there is such a big cushion. Well, should it take, it would happen, it will be a big shock, but we do not expect that to be happening. Shall we take the next round of questions?
All right, and that's where we leave it for now. Reserve Bank Governor Lesetja Kganyago telling us that the Reserve Bank keeping the repo rate unchanged at 7%. It means that the prime rated banks remains at 10.5%. A lot of concerns brought up there, but inflation, essentially, the forecast stays the same. Growth forecast at 0.4% for 2016, that remains the same as well. But some concerns over the US elections, the global economy, and the currency. We'll have full analysis after the break.
It's more than a gift, it's capturing summer magic. Get a Galaxy S7 Edge with Tab 3 Lite bundle for $6.99 per month